Okay, hi, good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, May the 14th, 2026, recording this about 6:40 in the morning. Okay, let's have a quick look and see what's going on. We're waking up to some relatively positive sort of sentiment over in China. There's been a lot of positive optics coming out of the Trump Xi kind of meeting. There's been talk about sort of more exports being sort of going into the US, China buying more sort of beef, opening up the markets, etc., etc. So positive optics at the moment. And you can see here that the ES futures are up. What are we up about 20 basis points? Nasdaq up about 14 basis points. And the Russell actually pretty flat. But basically, the stock market still seems to be pushing higher. What we're going to get today, we're going to get retail sales at 8:30, so in about a couple of hours. Retail sales will give us a read on the US economy in terms of from the consumer perspective. Is the consumer sort of starting to pull back because of the higher energy prices, sort of this higher inflation, which is bleeding into sort of services and goods apart from energy? Or will we see that, overall spending, at least in sort of nominal terms, is still relatively robust, supporting this sort of whole thesis of the K-shaped economy, that the top, 20 or 30% of sort of wealthy households are spending enough to compensate for the pullback and the pressure on the lower income households? We'll get a read of that on the retail sales. We'll also potentially get a bit more information coming out of the China summit, although I think just in terms of the time difference now, it's essentially sort of evening over in Beijing, and there's the state dinner where all the CEOs are there, with obviously the presidents, etc., etc. We also get Lagarde speech, and that's interesting because there's talk that the ECB may or may not hike coming up in June. So maybe Lagarde will give us a bit more information. But I just want to step back for a little bit because obviously yesterday, if you look what's happened, let's just put it on a 3-minute chart here. We had a similar situation with the PPI, which came in yesterday very, very hot. So let's just have a quick look and look at some of those numbers just quickly, just to put this all into perspective. Then we're going to do a quick sort of overview of where I think the market is at the moment. And you can see here that if we look at the US core PPI, you can see that that's really starting to rip higher, which is a problem. So it's not only the the headline number. So if you look at the headline, obviously that's at 3%. But the point here is that the core is also sort of ripping higher. So there's a sense here that some of the energy sort of spikes is actually starting to bleed into services and freight and transport and whatnot. If you look at the services here, you can see that's also up. You can see goods is up. You can also see that even core goods is up. Again, durable goods, non-durable core goods, so everything up there. And then energy, no surprises there. We know that energy was going to be a sort of a massive hike. If you look also at transport and warehousing, all of that's going up a lot because all of this cost of sort of fuels is going up, airfares going up. So the point I'm trying to make here is that are we in a regime shift, that this is sort of energy shock, which is kind of like just a one-line thing saying, hey, it's just sort of energy, it's transitory, everything's going to be hunky-dory once the Strait of Hormuz reopens. And there's no sign of that happening. And there's also no sign of China sort of putting pressure on Iran, although behind the scenes something may be happening. There's also no sign of Iran sort of saying, hey, guys, we're going to stop what we're doing. In fact, the contrary, what we saw yesterday from Iran is that the parliament is working on legislation, shall we say? I don't know if that's a valid word, but let's say legislation to essentially enlarge the area of the Strait of Hormuz, which will be under Iranian sovereign control, with the goal essentially of sort of, extracting taxes and tolls. So the point is that even if the Strait of Hormuz does open at some point, the cost of transportation for energy will be significantly high. We're talking maybe, $2 million per sort of a very large super tanker. So that all of that's going to be putting sort of upward pressure on supply chain costs and efficiencies. But what I want to do is just get back a little bit to sort of the big picture. So keep in mind, these pretty sort of crazy numbers we've got here. Year over year core PPI 5.2%. We also had, of course, the headline number. Where's the headline number here? Let me just find that. The headline number at 6%, 6%. So we're well above sort of any kind of, 2% here. Now, I know this is the PPI. I know it's a choppy number, but let's just see what's going on here and going back to some of the charts. So if we just, again, look at the, sort of the equities, what we're sort of seeing here is a sort of a snapshot. This is a 3-minute chart here. And we saw that very much a reaction yesterday with the PPI, similar to the day before with the CPI. And what do I mean by that? Basically, when we had the data come out, just say in the equities, you can see here that the data came out at 8:30, very, very hot PPI, again, similar to the CPI we had the day before. And you can see that the equities had a pretty nasty sell-off. But then we had a sort of a very, very robust sort of rebound. And that's where we are at the moment, just sort of, keeping on those highs. So if we go back to the daily chart, that's what we're seeing. We're seeing that the data is having a little bit of an effect, the inflation data, but then the market is sort of buying the dip, so to speak. So why would that be? And I think the overall theme here is that on the bullish side, you had this whole sort of AI strength sort of theme and the sort of and the sort of a big tech strength versus the inflation shock, and they're basically in battle here. And it does seem at the moment that the AI strength theme is outweighing the inflation shock. So we're seeing the inflation shock is sort of giving a few punches after the data is coming out, but then the sort of the tech and the AI story is sort of overwhelming that, and people are buying the dips. So but really, what's interesting me is really the rate market, because the rates market, so like the equities, they're asking the question, will the FOMC sort of reaction function become a little bit more symmetric? So when I say more symmetric, I mean, will they start thinking not only about potentially just delaying cuts, but actually potentially hiking? And you can see here that if we look at just the US yields, I mean, everyone knows these numbers, but let's say we're looking at the 2-year, you've got a 2-year yield now, which is, as we speak, just popped above 4%. It's come down a little bit, but basically 4%. So that's actually above the Fed funds rate. Remember that the effective Fed funds rate is 3.63. So just by context, the effective Fed funds rate is basically back down here. And this is where the Fed funds rate is, down here. And so the 2-year yield is above it. What's that? About 35 basis points, 37 basis points above it. So really what the 2-year bond market is saying is like, hey, Fed, we believe that over the course of the next 2 years, yields need to be higher. The Fed funds rate needs to be higher. So it's unusual to have the 2-year yield trading so much above the effective Fed funds rate. Although, of course, so that's the situation there. That's what the bond market is telling you. And also, if we look at the 10-year yield, we can see that it touched 4.5 yesterday. That, by the way, was a very nice sort of buy the dip there. So any of you bond traders out there, 4.5%, that represented a low on the ZN contract, and that was a good opportunity to buy the dip there, at least from a tactical sort of trade for the session. And then, of course, we've got the 30-year yield, which again sort of popped over 5%, and as we speak is 5.03. So the 30-year yield. So essentially, the rate market is asking the question, does the Fed need to be a little more hawkish in the reaction function, or let's just say symmetrical, not only biased towards the downside, but looking towards the upside? So in terms of the equities, why the equities are sort of shrugging off this inflation problem and the high yields, I guess, to be honest, the AI capex sort of capital expenditure cycle is real. There's definitely money being pushed in. We also have earnings are very strong. Profit margins are very, very good. So earnings are strong, profit margins are very good. And there's a genuine sense that with AI, there'll be need for less workers. So maybe sort of the component of workers, sort of wages will go down, and the productivity will be very strong. And that's actually all true. And so therefore, there is definitely a fundamentally a good bull case for sort of the equities, especially in this sort of the tech sector, and specifically the AI and sort of semiconductors sector. Okay, so therefore the indices, the stock indices, and if we just go back to just what's been happening, we look at the ES futures up here. We all know that NASDAQ is ripping high, although we're getting a little bit of a doji, maybe a little bit of hesitation today. But basically the stock indices are okay to have melted up so much because the engine is powerful. We're having this AI capex sort of cycle. As I say, the earnings are good, the profit margins are good, productivity perhaps is going to go up. So the engine is very powerful to push this up, and it's justified, but of course it's very, very narrow. It's just, and we can see the narrowness because we can see that obviously the semiconductors ripping higher, we can see the Mag 7s all ripping higher, but of course once we go down into the software, we can see that it's doing okay, but essentially it's nowhere near the semiconductors. Look at that huge difference there. And we can also see that the breadth of the market is pretty narrow. There's only sort of 10, 20, 40 companies which are doing very, very well. So the point is that The big question here is this going to be enough going forward for the equities indices to remain higher? Now, also at the moment, of course, we have this the famous sort of meeting in China, which is happening at the moment. And, we did get some comments from President Xi saying that China will be, continuing to open the door more in terms of for Western businesses. So that's a very positive for sentiment. And we obviously have Tim Cook there. We have Elon Musk. We have Jensen Huang of NVIDIA there. And there was also some talk coming out of China in the last few hours that the more advanced sort of NVIDIA chips that the Chinese would allow those to be sort of imported. So that's a positive for NVIDIA. So definitely some sort of positive optics is going. But as I say, the problem on against that is that inflation is not just energy anymore. It's not just crude oil prices. It's not just gasoline prices or jet fuel prices. It's on the refineries, but it's going, as we just saw, into the PPI. So into the inputs in for what producers are paying into areas like transport, warehousing, logistics, plastics, all of this stuff. Packaging is starting to cost more and more and more. So the thing is that from the Fed's point of view, we are starting to see sort of a pass-through pressure. So these prices are going from the headline CPI into the core CPI and into the core sort of elements. And the whole point is for the incoming chair Fed, Walsh, is that going to cause him to say, hey, it's transitory, it's just headline, it's just food and energy, which is going to pass because of the Iran situation, but it's actually going to be a much stickier kind of inflation, which will cause the Fed to stop ignoring it and potentially would cause a hike. That's kind of the bear case here. And as I say, you can see here that it's going to be very difficult for Kevin Walsh if this sort of just headline energy is going into the goods and services, transportation, freight. And what we just saw from the PPI data just showed you is that's the issue. So far, for equities, we could say, hey, it's okay. NASDAQ continuing to rise, the broader ES, sort of the S&P 500 continuing to rise. So it's okay because at this point, have we seen multiple Fed hikes? No, the market is still relatively sanguine. It's starting to price in a few basis points from a mathematical point of view by the end of this year of hikes. But at this point, we don't have a full hike priced in. And if we just have a look at that, we can just sort of just see where we're at with the pricing. We'll have a quick look here. So we'll start with the SOFR. This is approximate. This is so for the December SOFR period, which of course expires 3 months after, so more like sort of in the March period. So this is kind of an average. But what we can see here is the implied market a sort of a range for where those yields will be in that period, in that, let's call it the first quarter, more or less, of 2027. And you can see that on the daily chart here, that was at zero. So that's in pricing sort of equilibrium. But we've gone from, if you just go back, I mean, just look at how this chart has repriced from, let's say, December of 2025. We were down at sort of 4 cuts. And you can see that over the last sort of period, this has gone into sort of all the cuts were priced out, and now we're actually pricing in maybe sort of half a hike in some time in that first period in 2027. So the point is, but having said that, the equity market at the moment is okay. The equity market is choosing to say, hey, that's very cute, Angus, but we don't actually have any hikes yet. We certainly don't have multiple hikes. We don't have any credit stress. So again, if I look at, actually, I won't look at it now, but if we look at the sort of the credit indicators like high yield and investment grade, they're behaving themselves. So we don't really have too much credit stress. And also, we don't really have like a blow off top. We don't have any like a supercharged economy. We have an economy which is doing, relatively well. And we have a labor market which is okay, it's robust, it's solid, but it's not spectacular. So the bulls can point to that and say that's why the equities are okay to keep on sort of rising despite sort of this inflation, which could be transitory or could be sticky. But the thing is, with these higher yields, the rates market is much less sanguine, is much less relaxed. And so with these higher yields, it's basically looking at this very narrow leadership. And remember that the leadership is very, very narrow. It's concentrated, basically in the Mag 6 or 7. It's concentrated in the semiconductors, looking here at the charts. So it's becoming increasingly fragile with this very, very narrow leadership. And so, okay, we can again look at the China summit, which we're just happening, and say that's very positive for optics. And so for a tactical trade, what I'm trying to lead to here is that for a tactical trade, in the equities and some of these Mag 7 companies and like the Kospi and the semiconductors, it's absolutely fine for a tactical trade. But it could be that the regime will slowly change. If this inflation continues to show itself bleeding from sort of the headline numbers of food and energy into more core, that could be a problem. And at a certain point, we need to sort of think that that could be sort of the pressure which is going to cause equities to maybe start topping out at some point. So in the meantime, though, it's okay for a tactical just to remain long. But in the meantime, we need to be monitoring the rates, just keep on looking at these yields. And that's what I'll be looking at today, just to say, well, okay, the 30-year, is this going to sort of just sort of top out here and not really want to get too much above the 5%, and will dip buyers come in? Certainly yesterday, dip buyers did come in at 4.5% on the 10-year. So will it push higher? And then also on the 2-year, we have to see, is 4% around the top. So let's keep on monitoring the rates. We also want to keep on monitoring the US dollar. And we know that the US dollar has been pretty strong, in over the last sort of period. Let's just look at the dollar index here. You can see the US dollar continues to remain strong, and that is going to continue to put a little bit of pressure on the equities. And we also have to keep an eye on the credit spreads, which I'll just have a quick look at. Let's see, where are my credit spreads? Sorry, let me just see. Is that in ratios? US credit, yes, maybe that's no, actually. Sorry, guys, I just forgot where I put all my credit spreads here. Commodities, maybe in bonds. Credit risk, yeah, let's have a look. So if we look at something like the LQDH ETF, which is the investment grade, you can see that that's actually doing pretty well. It's actually going up in price. So this is the hedge one. So it cuts out sort of yields and just looks at credit risk. So that's up. We could also look at the high yield equivalent, and you can see that's not doing quite as well. So there's a little bit of tension there. But if we actually look at the spread between, let's say, the high yield and the investment grade, you can see that that's it's behaving itself relatively well. And just to put that in context, you can see just in moments of stress when this thing does blow out, and just to give you a sense of what this looks like. So you can see that if you look at something like COVID, you can see it blows all the way up here. And if you look at something like some of the other sort of pressure points, but so at this point we're doing sort of okay with the credit spreads as well, although a little bit of pressure is starting to come in. So far so good for the tactical long. But we need to just keep an eye on this idea that just one theme, a very narrow theme, which is the AI, the semiconductors, this one theme, which is very narrow leadership, it's absorbing a lot of pressure from the inflation shock and from the higher yields. And so the thing to keep in mind is just, how long will it be able to, this one theme will be able to support all of this other sort of macro pressure from the inflation, high energy costs, and the increasingly high yields. That's something to keep an eye on. So that's just sort of a bit of I thought I'd just have a little bit of a bigger picture look at things today. But just in terms of the specifics about all that stuff, obviously keep an eye on the China president, the China summit. Let's keep an eye on British politics as well. It seems there may or may not be a leadership challenge, but I think in a certain sense, unless we get the more left-wing candidate, the Manchester mayor, what's his name, Andy somebody who's much more left-wing, it seems like the UK pound is more or less absorbing that pressure, because there's no great expectations there of a massive change just for the moment, because we don't have the leadership challenge. So also, as I said, we have the data, initial jobless claims. We'll have a quick look at the state of the US employment market on a weekly basis. And of course, retail sales will give us a bit more information about the behavior of the US consumer over the last few weeks with the increased inflation and energy costs. Okay, guys, hope that was useful. Have a great trading day, and I'll be back tomorrow with the macro snapshot. Thanks very much. Take care.